Now, the American Consumer Price Index has eased up to 7.1%. It's, easing some of those worries of investors for sure, and it comes after analysts have been expecting the print to come in at 7.3%. And this, of course, means that inflation has further eased from the October print, which was 7.7%. So, the world's largest economy has reported its producer price index, its PPI, for November, and that has shown a growth of 0.3%. It came in only yesterday. Remember, it was only in June this year that US CPI touched 9.1%, and that had forced the Fed to take stricter monetary tightening measures. So what's happening on Wall Street on the back of this? Yes, there is cheer. Inflation in the US has eased to 7.1%, and we're looking at these numbers come as a big relief to investors. They are still wary, of course, about the Fed's approach to inflation. Will it halt its hawkish moves and dial down its pace of rate hikes? We will get to know that very soon after the FOMC meet, which is scheduled for the 13th and 14th of December ends. But let's, for the moment, take it across to my colleague Anisha, just to explain what one can expect from the Fed after they end that meeting. Anisha, where are expectations pegged?
Well, the last Fed meeting of the year, December 13th and 14th, would be widely tracked. While 72% of the participants believe there is going to be a 50 basis point hike, there are 27-28% of the participants which believe that 75 basis point hike cannot be ruled out. Now, remember at the last address by Fed Chair Jerome Powell, he had given the indication that the rate of interest rate hikes are expected to slow down, and that is why the street was anticipating there is going to be a 50 basis point hike. But separately, there were cues coming in that the interest rate upcycle could actually elongate, and that's why the terminal rate of, a hike would be important to track. So what's the projection coming in as far as the terminal rate is concerned will be important to track. Separately, we're also expecting the projection changes to happen when it comes to GDP as well as inflation. So those changes will be important to track as well, because when we had started off the year, the Fed was expecting that in 2022, we are likely to see a growth of around 4%. That has come down to 0.2% as of the September meeting. Where does it end now will be important to track. And similarly for inflation, while the year began with an anticipation of 2.6% inflation, it's already scaled up to 5.4%, and the street is expecting that there will be a bit more realistic number coming out now. So that will also be interesting to watch. So, if you look at the year so far, the Fed had already raised, raised by around 375 basis points. It started with a 25 basis point hike in March itself, and since then it has been continuously going higher. Having said that, inflation has cooled off considerably from the 9% plus level that we had seen in the month of June, where inflation had hit a 40-year high level. It's cooled off considerably, but it still continues to be high. So the commentary of Fed will be important to track. Whether it is a bit more hawkish or a bit more dovish, that will really be the key.
Yes, the commentary is something that investors will watch very closely, but let's get further perspective on US inflation and expectations of the Fed on those rate hikes. Geoff Dennis is joining us. He's an independent emerging markets commentator, along with Priya Misra, the head of global rate strategy at TD Securities. Thanks for joining us, both of you, here on this edition of India Tonight. Priya, it's always important to consider labor market trends when one considers inflation, because when we talk about services, for services, you need labor, and arresting wage growth within the labor force is always the key to control inflation. But in the American context, in the American economy, controlling wage growth has proved to be rather tough because demand has outweighed supply there. How hard do you reckon the Fed has to try still to get that price stability mandate right?
I think you're absolutely right. The market's cheering today. Terminal rate pricing has come down because I think we've seen, some downside surprise on inflation, but core services is still strong. And that's very much a function of wages. And so our view is that the Fed is going to sound resolute tomorrow. They're going to go 50. The dot plot is going to be of a lot of focus. We think while the median might be close to 5, there will be Fed officials above 5, precisely due to your point that they need to get the labor market to slow down. And the only way to do that would be to slow down demand. And they have to get wages down. And so, I don't think that they can afford to signal a pause in the hiking cycle. They're going to slow down the pace. As, Chair Powell said, they can recalibrate policy better. But we think they're going to have to continue to hike. We're looking for the funds rate to be rising up until 5.5 by the middle of next year. And then they're going to have to signal that they'll stay restrictive. So, I think there's the information we got now, which might allow the Fed to, perhaps cut rates when the economy heads into a recession. But I don't think anything today makes us think that the Fed will not continue to signal continued hikes, and this idea that they remain extremely committed to price stability. So I think the market may be a little too optimistic that 2 misses on inflation might be enough for the Fed to stop hiking, because they're looking at the labor market, which is still extremely tight.
Right. Geoff, do you agree with that perspective? In fact, when you look at core inflation rate, it excludes energy and food prices, which, of course, as far as core inflation is concerned, has been falling. But is that going to be enough to take a call on whether inflation is actually coming under control in the US, and then the Fed can act accordingly?
I think it is coming under control, and I'm a little bit more constructive about the policy outlook than my colleague here. There's no doubt that if you simply look at what was happening to inflation a year ago, these year-on-year declines are entirely predictable. We're going to get more of them, I think, going forward. So I think the issue today is going to be, or perhaps I should say tomorrow when the Fed meets, is going to be, do you get a more dovish signal about where they stop tightening? They're obviously going to go, I think, 50 tomorrow. There's probably at least another 50 to come early next year, probably in 2 times 25. But I think what this does is confirm the long-term trend downwards. And I think it makes it more likely the Fed will stop at around the 5% rate. But as Priya says, we're not going to get a Fed that says everything's done tomorrow by any means. They are going to be resolute. I like that word, by the way. Wages are a problem for sure. What I think is going on, and I live in the US, of course, and see this all the time, nobody really understands what's going on with the dynamics of the labor market, with extraordinary shortages of labor across the economy. And I think there's a big structural change going on in the labor market that's going to lead to 10 years of papers from economists about labor economics. Nobody knows exactly what's going on. They have to get wages under control, but I think with inflation, nonetheless, coming down the way it's coming down, it's going to continue to come down, probably 4% by the end of next year. They can afford to stop at 5%, because I think early next year, the economy is going to be pretty soft.
Right. And Priya, how much has the decline in commodity prices affected American inflation, according to you? Will that trend continue? And how much do you expect the Fed to move with the kind of inflation print that we are seeing? Do you think the decelerating trend in inflation is only going to help the Fed realize that the rate hikes are working? But the question still remains, will it be enough to raise rates at a slower pace? Because you did mention that by March, we are going to look at 5 to 5.5%. Do you think that they are on course to do that? Or do you think it's going to be a more longish period?
Sure. So I think commodity prices are a big part of why we've had these downside misses on headline. I mean, it's commodity prices and it's goods deflation. Something that if you track supply chain pressures, they do seem to have been easing for the last few months, and now we're seeing it in the data. I think, though, with the US, services is a much bigger component of the consumption basket. So I think service inflation is going to be key. And in that, and actually Chair Powell gave a great speech where he talked about shelter inflation, ex-shelter services. I think it's going to come down in terms of Fed policy rather than overall headline CPI. We need to see that service inflation starting to decelerate. And we're seeing some signs of that. I think the question is how sticky that decline is going to be, or how quickly does it decline? In our view, it's going to be a bit sticky. The labor market, and Geoff talked about this, the labor market's extremely tight. If wages stay under pressure, it's going to keep core services inflation somewhat sticky on the way down, and that'll force the Fed, perhaps at a slower pace, and maybe they downshift to a 25 now. We think they're going to have to keep hiking into the second quarter. Now, your question, is it working? I think, it is. The Fed has tightened a lot at the fastest pace, and it's been a global increase in interest rate. I think all of that adds to tight pressure. And so I think we look at inflation, which is a very lagging indicator, but also let's look at growth. The growth in the US economy is still very solid. I mean, other than housing and manufacturing, we're not seeing signs of big slowdown. When does that happen? And I think that will inform Fed policy as well. In our view, first quarter is still going to look okay. It's really, we are penciling in a recession, but that's more a second half of next year's story. So I think that'll, if the economy stays robust, inflation is a bit, think the Fed keeps hiking at a slower pace, but they can hike to maybe 5.25, 5.5, or 5. I'll give you in that range. They stop there, and then we wait to see how quickly does inflation decelerate and how quickly does the economy slip into a recession, which will then force the Fed. And the market forward looking, we're already pricing in rate cuts in 24. I think that's going to be the big debate next.
Priya, I must apologize to our viewers because the line to you right now is a little sketchy. But of course, we are also looking at how this can pan out for emerging markets. And Geoff, for that, I'm going to come to you because you watch in emerging markets very closely. You watch the Indian economy. How much has American inflation actually impacted the Indian inflation trajectory, in your opinion, from an import-export perspective, and perhaps that reflects in the way some of our stocks move in our markets as well, the more export-oriented stocks?
Well, the Indian inflation rate has actually really been relatively well behaved. It may not feel like it, but relatively well behaved compared to a lot of areas around the world, especially in the developed markets, of course. And this has been a particularly bad inflation story in the UK and in Europe, for example. But as far as I'm concerned, the key part of these developments that you saw with both the October CPI and the November CPI that impacts emerging markets overall is the drop in the dollar. The dollar's going down again today, and that tends to bring, as I've said on this program many times before, tends to bring money towards the emerging markets. Now, when you have a year when developed market stocks are down as much as they are, for emerging markets, okay, they've underperformed, but only by about 400, 500 basis points. It's been a relatively good performance. And I think if the dollar comes down and my scenario plays out, bond yields peaking, stock market bottoming out, dollar coming off the top slowly, I think it's going to be very good for emerging markets next year, including for India. The wild card in the emerging markets, without any question, is what happens in China, given its huge size in the index, but also given the fact that we don't know what's going to happen in the country of China now that the zero COVID policy is basically being walked away from. Are you going to get a massive, a spurt of COVID cases? So China is the big risk, but for sure, these macro developments, some debate about where the peak in the Fed is, yields at the top, anticipating the peak in the Fed, stocks bottoming out, rallying, the dollar peaking out, all good, I think, for a much better year for emerging markets next year, which will include India.
Which is actually music to one's ears. But when you come to the commentary that we are expecting from the Fed, that is actually what market watchers are going to be tuned into very closely. Priya, what exactly are you expecting to hear from them? Are they still going to say, in your opinion, that they are going to rely on data, because that would really spur the markets even further? Already, of course, the US markets are celebrating the inflation print.
Sure. Making sure that you can hear me okay?
Yes, this is slightly better, Priya, yes.
Okay, perfect. So we are expecting the Fed to hike 50. That's already priced in. It's all going to come down to the dot plot and how many Fed officials are looking for the terminal rate at 5 or higher. We actually do think there'll be a bunch of Fed officials looking for above 5% terminal rate. And so I think that's going to sound a little bit hawkish relative to where market pricing is, especially after CPI. I think there'll also be a lot of talk around a recession. And I think Powell is going to push back hard on that because the data is still very strong. The labor market is tight. We don't think that this idea that the recession is baked in the cake, that the Fed is going to buy that and say that they've already over-tightened. So I think the message might sound a bit hawkish. The market might well ignore it because, I think people are worried about a recession and they've seen the inflation numbers. So I think they might call the Fed's bluff in terms of not cutting rates next year. But the near-term message is going to be slower pace, but we remain really focused. I think the Fed's going to say that they remain very focused on service inflation. And today's number wasn't that low on service inflation. So I think that can move front-end interest rates in the US a little higher because, they still have to keep raising rates to get that service number down close to 2%.
Geoff talked about what he is seeing on the US dollar. Where do you expect the US dollar now to head towards? Do you find it going to be stable at a level that you are working with, Priya?
So we're definitely thinking it stays very range bound. As much as we're concerned about a recession, the US is still much stronger than the Eurozone or the UK, or, I would even argue emerging market right now. So we think the dollar has peaked, but we don't see it heading much lower because we think the Fed has to keep raising rates and the economy is still holding strong. So staying fairly within like the last month range is where we see over the next 6 months the dollar stays here.
Priya, Misra and Geoff, thank you very much for joining us with your perspective on what we are seeing by way of US inflation and what we are expecting out of the Fed at the end of that FOMC meet, the last meeting of the year. And of course, the commentary is something that we'll be watching very closely, and that's something we won't have to wait too long for. But thank you both for joining us on India Tonight.